Hey guys, it's Julie here with TipRanks, and today we're taking a look at 3 energy stocks that a 5-star analyst has a 100% success rate on. So let's get into it. All right, welcome back everyone. Thank you all so much for being here. I hope your week is off to a great start. Today, I was perusing the profiles of some top-ranked Wall Street analysts when I came across one who had several stocks in her coverage that she had a 100% success rate on. So today, we're going to take a look at those stocks, what it is that they do, how she weighs in on them, and if the rest of Wall Street agrees. Just before we get into those, I wanted to give you a heads up that TipRanks has kicked off their Black Friday sale. So right now, you can get 40% off premium subscriptions. If you've been wanting to unlock some fantastic investment research tools, now is the time to do so. So head on over to the TipRanks website now to take advantage of the sale. Now, the analyst that we're taking a look at today is Elvira Scotta from RBC Capital. I found her under the top analyst page over on TipRanks, and here we can see she's currently a 5-star analyst, ranked number 22 out of nearly 9,200 Wall Street analysts with an average success rate of 71%. And you can see in her list of stock coverage several companies that she has a 100% success rate on. And just before we jump into those stocks, this is a friendly reminder that if you enjoy the video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. First on our list today is Kodiak Gas Services. They trade under the ticker KGS, currently priced at $37.48. In the last 6 months, the stock has climbed 33%. This is one we did talk about near the end of September, I think beginning of October. In the last 3 months, they've gained 46%. Kodiak provides large-scale gas compression services on a contract basis for field gathering, enhanced oil recovery, gas lift, and processing. The company has well over 4 million horsepower of operating equipment in its fleet and boasts that this fleet is the most energy efficient and newest in the industry. They can design, build, and commission compressor stations and other natural gas midstream infrastructures, as well as contract for operations and maintenance of customer-owned infrastructure and equipment. This makes them a leading provider of compression services in the U.S. energy industry. Kodiak does pay a quarterly dividend, which is currently 41 cents per share, with the payment date just happening on November 8th and a dividend yield of 4.25%. Earlier this month, on November 7th, Kodiak did share their latest quarterly report, and results were mixed. While earnings did fall short, revenue did beat expectations. Revenue of $324 million beat estimates by about $18 million and grew 40% year over year, while they reported a loss per share of 7 cents, which was well below the anticipated earnings per share. That was due to a $9.9 million long-lived asset impairment and a $10.4 million loss on asset sales during the quarter. They did see record quarterly adjusted EBITDA and free cash flow and repurchased 1 million shares. They also raised their full-year adjusted EBITDA guidance looking forward. Following that earnings report, our top RBC analyst increased their price target on the stock. They noted the strong Q3 results and the raised adjusted EBITDA guidance as demand for compression horsepower remains strong. Favorable market dynamics and growing natural gas demand will continue to drive Kodiak Gas Services pricing and utilization higher. She rated the stock a buy. That increased price target of $40 would imply an upside potential from nearly 10% from current prices. And with those 10 ratings in the past, she does boast that 100% success rate. Overall, Kodiak Gas Services does come in as a strong buy with 8 current ratings, coming down to 6 buys and 2 holds. But with so much growth recently, the average price target of $35 would actually imply a downside of 6%. Looking at those recent ratings, the more recent ones here in November do still have some upside potential, while our older ones from back in September and October now have downsides, with the stock surpassing them. Number 2 on our list is Enterprise Product Partners. They trade under the ticker EPD, currently priced at $31.46. This is another stock we've talked about several times before over this entire past year. In the last 6 months, they're up nearly 14%, and in the last 3 months are up nearly 9%. EPD is a leading North American provider of midstream energy services. In fact, they're one of North America's largest midstream firms with a $68 billion market cap. They move crude oil, natural gas, and natural gas liquids from production fields across the U.S. to storage and terminal facilities on the Gulf Coast. And the operations that generate success on this scale are enormous. They control pipeline assets that total more than 50,000 miles and stretch from several regions, the Rocky Mountains, the Northern Plains, Appalachia, and Southeast, into Texas and the Gulf Coast. EPD is known for their attractive dividend yield. The company is an MLP, so you will get a K1 come tax time. Their current quarterly dividend is 52 cents per share for a dividend yield of about 6.7%. They shared their Q3 earnings report at the end of October, and they did have a slight miss on both earnings and revenue. Their third quarter earnings per share came in at 65 cents, missing estimates by 2 cents per share, while revenue came in at $13.78 billion, missing by $90 million, but did grow over 14% year over year. Their distributable cash flow did increase 5% year over year, and they repurchased approximately $76 million of their common units. And this is another stock that our top analyst Elvira did recently raise her price target on, saying that the firm expects the company's strong balance sheet and steady cash flow to provide financial flexibility while progressing on its backlog of growth projects and maintaining optionality, as shown in their announced acquisition of Pinon. That last buy rating was her 16th rating on the stock, and she does have that 100% success rate. She bumped up her price target to $36, which would imply an upside potential of nearly 16%. With 8 current analyst ratings, EPD does come in as a strong buy with 7 buys and 1 hold. And the average price target of $34.29 would imply an upside potential of 9% from current prices. Looking at those ratings down below, on the low end we do have our buy rating here from Barclays with a downside of 1.5%, while our high-end price target comes from Truist with an upside of 17.5%. If you've made it all the way to our third stock today, this is a reminder to make sure you hit that thumbs up button. The third stock that Elvira has a 100% success rate on is Targa Resources. They trade under the ticker TRGP, currently priced at $198. And this is yet another one that we did touch on before. I believe the last time was around February or March. In the past year, the stock has climbed over 130%, gaining 70% in the last 6 months and 38% in the last 3. Targa Resources provides natural gas and natural gas liquids midstream services. They are one of the largest infrastructure companies delivering natural gas and natural gas liquids in the United States. They own, operate, acquire, and develop a diversified portfolio of complementary midstream infrastructure assets, allowing them to efficiently supply this natural gas to domestic and international markets, meeting the increasing demand for cleaner, affordable fuel and feedstocks. And like our other stocks today, Targa is also a dividend-paying company, with a current quarterly dividend of 75 cents per share for a dividend yield of 1.43%. Targa came out with mixed results for their third quarter on November 5th, beating on earnings but missing on revenue. For their third quarter, they reported earnings per share of $1.76, beating estimates by 20 cents per share, while revenue came in at $3.85 billion, missing by $210 million. The company did see record adjusted EBITDA of $1.07 billion and record Permian NGL transport and fractional volumes during the third quarter. Looking forward, they expect their full-year EBITDA to be above the top end of their $3.95 to $4.05 billion range. And this is yet another stock that Elvira increased her price target on, noting their strong Q3 results and raised guidance, with the backlog of growth projects expected to provide meaningful cash flow benefits that enhance their capital returns over time. She's rated the Targa Resources stock 18 times before with that 100% success rating, and her recent price target was $199. And with 13 current analyst ratings, Targa Resources does come in as a unanimous strong buy. But this is another stock with all that recent growth that has already surpassed many price targets. The average price target of $186 would be a downside of 6%. Some of those more recent price targets have a slight upside potential, one of them being 3.5% from Bank of America, but a lot have already been surpassed by a decent amount. So that is a quick look at 3 energy stocks, all with ratings from a top-ranked analyst at RBC and a strong buy consensus overall, though many of these stocks have seen a lot of growth lately. Do you think they've hit a ceiling here and are going to cool off, or is there room for more growth ahead? Let me know your thoughts in the comments down below. I always appreciate hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are up to, so please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a wonderful day, and I'll see you back here next time.